Welcome to the last segment of Introduction to Quantitative Decision Making, Bond Valuation. Okay, sorry. So in this particular unit, we're going to look at bond valuation in a variety of contexts. Of course, we're going to start off with what the heck is this thing we're calling a bond? It's just nothing more than borrowing or lending money, really. It's like a loan, okay? But it's a particular type of loan. And so we're going to look at the price of that bond in a variety of contexts. On or between interest rates. We're going to determine what the purchase price of the bond is when the market rate, that's what the going rate, if you prefer, for interest is, versus the bond rate, which is something that's set in the bond contract itself. Okay, probably won't get a chance to do too much with the bond schedules and the amortizations and stuff like that, but yield rates are an important metric. Now, yield rates in the advent of modern calculators are actually fairly straightforward to calculate at our level. It can be a whole host of complex problems because so far we kind of take that interest rate as a given, right? It just comes to us. But there is a whole lot of things that go into the calculation of an interest rate, and then there's a whole bunch of really cool math involved in discussing the term structure of interest rate. What the difference between a 1-year rate to a 2-year rate to a 3-year rate and so on. So there's lots of stuff there. But bonds are really just a merger of all the stuff we've done so far in this course. Got a little bit of compound interest in there, got an annuity in there, and sometimes we sprinkled it with the pixie dust or the little sprinkles of days between dates just to make it a really, really fun. All right, we name a whole chapter. It's called Bond Valuation. Got to start with, hey, what is this thing called a bond? Now, bonds are it's just a borrowing or lending, depending on which side you're at. So larger corporations and governments tend to use bonds to borrow money, right? Investors, the mechanism for investors to lend money to those typically larger entities. There's a bit of transaction costs associated with a bond issue that limits their feasibility regarding small corporations or sometimes even medium corporations. Okay, so the borrower, kind of writes up a contract, which we call the bond contract, and a lot of the elements of that bond relationship or this borrowing or lending is set out into that bond contract. Okay. Now, there's some basic sort of elements to this bond contract, and these basic elements have been part of a bond contract for a very, very, very long time. And by very, very long time, I mean very, very long time. Any of you legal eagles out there may note or may recall what the Code of Hammurabi is, one of the earliest known codification of laws in human history. And in that Code of Hammurabi, guess what's in there? The basic elements of a bond contract. And they're essentially these ones here, right? So that hasn't changed for thousands of years. Code of Hammurabi sets out a bond contract. So first big thing is you have this face value, okay? And that's just like a lump sum, okay? So like the slide says, amount owed to the holder of the bond when it matures, okay? So bonds tend to be an interest only, right? The payments tend to be only payments of interest. And then you get a lump sum at the end of the term of the contract. Okay, so a little bit different than an annuity. So for instance, in an annuity, when we were buying a car loan or we buy a car, we got a car loan, we paid a little bit of principal and interest with every payment. This bonds tend not to work that way. You tend to pay the interest, and then there's a lump sum payment at the end that represents, typically represents a principal. The bond rate, sometimes called the coupon rate, and that is the rate of interest that is paid. We use that to calculate how much interest is paid at every period. Okay, that is set out in the contract. Okay, now maturity date is when we're supposed to get the principal of the bond is supposed to be paid back. And lastly on this slide, the principal amount. Sometimes it's called the maturity value as well. Okay, and again, it's the amount paid to the issuer when the bonds are surrendered. So kind of related to the face value. Now, most bonds are redeemable at par. When we say redeemable at par, we mean face value. So at par means 100% of face value, which means it's the same as face value. There's nothing that says it has to be that way, though. And this is very important. Okay, and it's a lost point. Okay, so, you know, spoiler alert, some questions talk about par values that aren't the same as face value. And that could be because the bond borrower or the bond issuer wants to have a feature in the bond that's not very favorable to the bond investor. And in order to sort of entice the bond investor to still lend the money, because this is a voluntary contract after all. I mean, nobody is forcing anybody to issue a bond, nor is anybody being forced to buy a bond. So you put in a feature, the bond issuer puts in a feature such that, the bond investor doesn't like it, and the bond investor says, okay, well, I can deal with that, but you're going to have to compensate me for this feature I don't like. And one of the features is called callability. That's where the bond issuer can call the bond back before the end of the bond, okay, or before the end of the term of the bond. And typically the reason why the bond issuer is doing this is because interest rate on that bond is higher than interest rates on other similar investments, and the bond issuer is going, I can get a better rate somewhere else, and I sort of like to get rid of this bond and go borrow it from other people who are offering a lower interest rate. As you can probably guess, to the bond investor, this is like, I got a bond paying a lot more interest than all other bonds. I'm very happy. I don't want to have to give this up. So as compensation for the potential, financial hit that a bond investor may face because of callability, often the bond is callable, but at a percentage greater than par. So the example here is maybe 104% of the face value. It could be 102% of the face value, whatever. Something just to compensate the bond investor because bonds tend to be called at a time that's disadvantageous to the bond investor. And the bond investors will go, we're not so interested in this issue if you're just going to kind of mess with us a little bit whenever things get in our favor. Okay. So lots of features can be built into this and into bonds. So coupons. Coupons is what gets paid, and that's kind of like the amount of interest. So for instance, the example I have here on the slides is we got a 20-year $1,000 bond. Okay, so that's 1,000 just means the face value. You could buy several of these to kind of accumulate it into large sums, and that's typically the case. A 20-year $1,000 bond bearing interest at 5% payable semi-annually. Now, you will see that bearing interest at 5% payable semi-annually. Payable is your clue that is the rate used to find the coupon payment. Okay, so once you see that 5% payable, that means, okay, this is used to calculate the coupon payment. That regular stream of payments that we got used to in an annuity. It's the same thing here. Okay, so very important terminology, because as we get into bond questions, there'll be a market rate and there'll be a coupon rate. We want to keep the two distinct. So it's payable semi-annually. We'll have attached to it at a date of issue 40 coupons at $25 each. Okay, so when you work out 5% of $1,000 happens to be $50 because it's payable semi-annually, means paid twice a year. We divide that by 2 and we get $25 individual payments every 6 months. Coupons. Why do we call it a coupon? In the old days, no, actually not so old, but pre-computer trading. Often when you got bonds, you got certificates, and certificates all around had sort of the bond. It looked, what the bond was, and it was, very pretty and things like that. And then around the outside of the bond were these little coupons that you would clip off and you would take it to the bank, just like you would take cash to the bank, right? So there'd be like a little date when the coupon could be redeemed, and you'd clip off the coupon and you take it into the bank, you put it in your bank account. And if you watched the Die Hard, the first Die Hard movie, with Bruce Willis and stuff, my favorite Christmas movie, you'll see that the bad guys were stealing a whole bunch of bearer bonds, and you see the coupons, you see the bonds, they got stacks of them, and they're paper, and they look all cool and pretty now. Nowadays, it's just all electronic transfer. You actually don't get a certificate any longer, but in those days where you didn't quite have all this level of computer sophistication, you still actually had a physical bond that you can then move around, buy, sell, and if you sold that bond, the certificate eventually had to make its way back to the buyer, and there was all sorts of companies that were in charge of doing that transfer. So anyway, so bonds for which no security is offered is called a debenture. Sometimes bonds could be secured against a plant or equipment or a revenue stream of some sort, and then sometimes they're not. They're just, hey, the good faith of the company or government bonds, there is no security, so it's just on the good faith of the government to pay that money back. Okay. Now, after they're initially issued by the bond issuer, the corporation or the government, they can be freely traded. You could take that bond and you could sell it to somebody else if you could find somebody willing to buy it. Okay, and that's where things get really interesting is the buying and the selling of these bonds and the price determination of these bonds after the issuance, but before the maturity date. And of course, as we can imagine, if you follow any financial news, bonds are traded very frequently between interest rate payment dates as well as before maturity. Okay? So it's really easy to find, relatively easy, I guess, to find the price of a bond on an interest payment date. But if you have a bond, like the one we were just discussing, with semi-annual payments, you kind of know that bonds are going to be traded more than twice a year, right? There's 252 trading days in a year, and bonds can be traded on any of them. Right, not just the two interest rate payment dates. There's 250 other dates on which the bond can be traded, and now we have to determine the price of that bond on those dates. Right, and that's those dates. Those 250 of those 252 dates fall between interest payment dates, and that's where the fun starts. Okay, so when we do that, it's just a two-step process. Okay, so it's not complex, but it has a lot of things to manage. So it's sort of a management exercise. Okay. So first step is we find the price on the date of the bond on the interest date immediately before the date of the purchase. Okay, so that's our first step, because finding the price of the bond on an interest payment date is relatively easy. So we're going to go to an interest payment date just before the date of sale and calculate the value of the bond on that date. Again, fairly easy kind of calculation. Okay. Then we say, okay, we need to adjust this bond because from the date of the most recent coupon payment date until I sell the bond, interest accrues. Accrues means interest becomes owed but not yet paid. Okay? So interest pays, because you loan somebody some money between the last coupon payment and some other date. Well, you want interest, you as the potential seller or the bond holder, that you want interest on that, right? You're owed that interest, right? Just because it hasn't been paid to you doesn't mean it's not owed. Right, so I mean, for you accounting folks, you're all pretty excited because you deal a lot with keeping track of things that are owed but not yet paid, but have to be paid in the future. And you got accounts payables and all that kind of good stuff going on. And it's kind of like that, right? It's an amount owing, but it's to be paid. Right? It's like your cell phone bill. You're 15 days into your cell phone period. You owe the cell phone company for those 15 days that you've had the phone. Yes, the bill doesn't come due for another 15 days, but if you were to cancel your phone now, they would say, hey, you got to pay us for the 15 days that you had it. It's no different with bonds. And so we have a little bit of a nice little tool where we'll adjust, we'll do an adjustment to reflect the fact that, hey, there's an amount owing here that hasn't been paid. And that involves us revisiting our good friend, the days between dates calculation. Okay. So in that second step, in the first step, it's all chapter 10, chapter 11, or if you prefer, unit 8. It's all annuity stuff. The second step is all about finding compound interest with a little splash of days between dates in there. That second step messes up folks the most. Right, because you got to get that days between dates in there, and you got to keep track of a whole bunch of floating dates around here. So again, it's not super hard, but you got to stay organized, and the timeline is crucial. Okay, when we did equivalent payments, we had to have that timeline because there's just so many moving parts to keep track of. It's the same story here. Timeline, so terribly important. So there's some terminology. Again, we're talking a lot of terms just so we get the language down. So bonds are offered for sale at a market price. Well, duh, right? Okay. And so we have a couple of sort of words that are a little bit distinct from each other. We have what's called the cash price. And I think in slang sometimes it's called the dirty price, if in bond slang. But the cash price is the price you actually pay for the bond. And the cash price is essentially the combination of those two steps we were just talking about, right? You take how much is owing at the preceding coupon payment date adjusted for accrued interest, and that's how much you have to pay if you want to buy that bond. Now, the quoted price is what you see quoted in markets. So if you look at a quoting device, Morningstar or something like that, they'll tell you the quoted price. They won't necessarily tell you the cash price. The reason why they do that is the quoted price takes out the effect of the accrued interest. Okay? Because that accrued interest is in there, but it may make a bond look more valuable just because it's got more accrued interest. Well, that doesn't make it a better bond. It just means it has more accrued interest. So in order to be able to compare across bonds with different coupon payment dates, it would just make a little bit of an adjustment for that accrued interest. And they call it the quoted price, just so you can facilitate some cross comparisons of bonds where the coupon payments are at different periods and the level or the amount of accrued interest is different for different bonds. Okay. And again, that accrued interest is just interest that is owed, but it's not yet paid. The interest is only paid on the coupon payment dates, but it doesn't, it sort of gathers up as time goes on. It's just paid every 6 months or every quarter or what have you, depending on how the bond is arranged. Okay, got a lot of stuff coming at us here, and we're just going to pile on just a little bit more. Okay, so bonds, sometimes they don't equal you can go and you buy and you can sell a bond for a value that's not the same as the face value, or not the same as the principal amount of the bond. That happens most of the time, right? Now, a couple of things to keep in mind with this terminology is we say a bond is trading at a premium when that purchase price, which we have to calculate, is larger than the principal value of the loan. And conversely, the discount is where that purchase price is less than the value of the principal or the amount that was originally owed or borrowed or lent. whatever. Okay, so we have premiums, we have discounts, and they're essentially just the differential between the purchase price and the principal. Okay, if the purchase price is higher, you have a premium. If the purchase price is lower, the bond is trading at a discount. Okay. How much it's at a premium or discount? Just take the difference between the principal and the purchase price. So not complicated, but there's a lot of little details to keep track of in this particular bond unit. Okay, so with the bond rate, recall that the bond rate is the contractually obligated interest rate mentioned in the bond contract and is used to calculate the coupon payment. But there's a market rate, right? The interest, the market rate for interest of a bond of a similar quality, same kind of company, same kind of security, all that kind of good stuff. The market rate changes. It goes up, it goes down, right? It goes all around, right? The fact that you put an interest rate in a bond contract, everybody else goes and says, okay, well, that's fine for you, but we don't necessarily agree with that. Or circumstances, economic circumstances, the company's circumstances change, and the market rate may change as well. So the market rate fluctuates, even though the bond rate is set by the contract, and it does not change unless the contract allows it to change. But typically, it does not change. So in situations where the bond rate and the market rate are the same, now we're going to call the bond rate B and the market rate I, but where they're the same, we say the bond is trading at par or sells at par. Okay? Now, if that bond rate is less than the market rate, the bond rate sells at a discount. Why does it sell at a discount? Well, if you have a bond that's paying 5% and everybody else's bond is paying 6%, whose bond do you want? I want the 6% bond, right? I mean, if you're offering me this 5% bond and somebody else is offering me a similar quality bond for 6%, I'm sorry, you're done. I'm going with the 6% bond, right? And so the price of your bond has got to kind of adjust. You've got to sell at a discount because you're selling a bond that people don't like as much. So you got to discount the price of your bond so that the two bonds are now trading at an equivalent price. Conversely, if you've got the 5% bond and the market rate's 4%, whoa, we're loving your 5% bond right now. We're loving it so much that we might offer you a little extra money for it. And then somebody else goes, hey, I'll offer more than that person over there. And eventually the price of your bond goes up, and now it's trading at higher than par, which we call trades at a premium. Okay. So we compare the bond rate to the market rate. And it's really like buying and selling any other good. Right? It's no different. No different. Okay, so when I said we're talking about the purchase price of the bond, and it does have two components. It has all that compound interest stuff because we get a lump sum at the end of the term of the bond. Right? And so that lump sum doesn't, it's like finding any future present value that we did in the compound interest. And then the stream of coupon payments, that's like an annuity, right? Payments happen at a regular interval. The payment amount is the same, right? It's classic annuity stuff. We bring them both together. So if you like working with the formulas, that means you're using both of those formulas from the compound interest unit and from the annuity unit. On the calculator, it's much simpler because we're just going to have a value in the future value. In FV, we now have a value. So often we said, there's no lump sum payment due, and so we made FV 0. Well, now there is a lump sum payment due. FV no longer 0. Okay? And so it's using the technology, it's a little bit easier, but the formulas behind the scenes are good to know, and especially if you go further into this topic, it becomes very important to know. Okay. So we have a picture here, and we'll do a little bit of an example. So we have a $5,000 bond bearing interest at 4.5%, payable semi-annually. Okay, so that payable word, so important to us, and it is essentially telling us that I am going to use that 4.5% rate to calculate the coupon payment. Okay, so payable semi-annually, matures in 10 years. So now I know when the bond ends. I know the face value. If it is bought to yield, that word yield is important because once I see the word yield, that's talking market rate now. Okay, so those two words, payable and yield, are extremely crucial here. I cannot emphasize enough how extremely crucial they are. Compounded semi-annually, what is the purchase price of the bond? Okay, so right now, I have a bond that's contractually obligated to pay 4.5%. Everybody else's bond is paying 3.3%. First question in my head is saying, is this bond trading at a premium or is it trading at a discount? And because my bond rate is higher than the market rate, it's trading at a premium. People want this bond, right? Right? Because all the other bonds are paying 3.3%. There's this bond over here paying 4.5%. Hey, we're all over this 4.5% bond. This is the one we want, right? So I already know that my purchase price is going to be higher than $5,000. Now we calculate exactly what it'll be, but I know for sure it's going to be higher than $5,000. And if we look at a cute little picture, we see each one of our little payments happening because the bond is payable semi-annually. So every 6 months we get a payment, our coupon payment, based on that 4.5% rate. And then at the very end, we get a coupon payment and the lump sum back. That is very important, and it's very important throughout this whole particular unit, is on the maturity date of this bond, two things happen. We get a coupon payment, woohoo, and we get the face value of the bond back, or we get the face value of the bond. Okay. Two very important things. Let's work this problem through. So here, nothing in here suggests that this bond is being purchased or sold between coupon payment dates, right? It's just saying it's bought to yield, matures in 10 years. So we can infer that the date of sale happens on an interest payment date or at the origination of this particular bond. Okay. So with that being the case, it is an annuity, right? And step one, and sometimes the only step, is just that we find an annuity, right? And so we have our N, we have our I of our present value. Now this is what we want to find because present value is just another way to say, hey, we're looking for the price. We do have our payments, which will be based on the coupons. We do have a future value. Okay, we'll call that a face value in this case. And we also have a payment structure, and we have a compounding structure, same as we had before. Okay. So N is the number of payments, and we look and we see, okay, matures in 10 years, 2 payments a year, so 20 payments. Now what's I? I refers to the yield. Okay, so I is the yield. Okay. So that's the market rate of interest, which in this case is 3.3%. Compounded semi-annually, so that is 2. The payments happen to be every 6 months as well. That's common, but doesn't have to be. Payment, that's based on the coupon payments now, right? Now we have a payment of 0.045. That's our interest rate. Divide that by 2, because there are 2 of these per year. And then I multiply that by the $5,000. Okay. Now, if you're using a TI-83 or 84, you could actually just do that calculation in the little payment slot. If you're using the BA2 Plus, then you can't do it that way. And you just have to figure it out separately. Okay. And I'll just figure it out separately, and it's $112.50. Okay. Every 6 months, we get $112.50. The face value is $5,000. Okay. Positive payment, positive face value. Okay. After that, we just run through and we calculate it just like we did before. I'll just do a quick refresh on this one, just so that we're sort of up to speed here. So we're still working finance, still working TVM solver, right? And we still have our situation with the BA2 plus. Okay. So N is 20. So I punch in 20 if I'm working the BA2 plus, and I punch in 20 and push N if I'm working the BA. I punch 20 if I'm working the TI-84, and then I punch 20 and then enter if I'm working the BA2 plus. Okay? Same as I did before. The yield is my interest rate, so I go down to my interest rate, 3.3, and when I'm doing this on the BA2 plus, I go for 3.3 and just push the I over Y. Okay. For the present value, I don't know what that is, so I'm just going to leave it as the old value I had in there. The payment structure, it's $112.50. That's positive because there's money coming towards us. It really doesn't matter if we look at it as the issuer or as the lender, but we'll just keep it as if we're buying the bond. 112.5 for the BA2 plus, and I push the payment number, and great, I got all that. Now the new wrinkle that we have here is we do have a face value of $5,000, so I push 5,000 in the face value, and I do that for each respective calculator. Okay. Now the P over Y and C over Y, I'm going to put that to 2. It's supposed to be 2 and 2. Okay. I'm going to go second and I over Y at the BA2 plus. Going to push 2, enter. See the little equal sign, that's good. I'm just going to scroll down, take a peek at C over Y, make sure it did change. I've never had the situation where it didn't, but paranoia, right? And then second, and then the quit or CPT button. Okay, so now I'm all set, and I scroll over to the PV button, and I go alpha, enter. I get $5,507.52. In line with what I would expect, right? We were expecting it to trade at a premium. It does. And for the BA2 plus, I go CPT, present value, and I get $5,507.52. In both cases, that's great. That's the value of this particular bond. Very happy. Things have all worked out very, very nicely for us. Okay. The next unit I am going to talk about, the more interesting case, is when we got the purchase is between interest payment dates. Get to use a little bit more of our tools in this particular case.